Bloomberg Audio Studios. Podcasts, radio, news.
Welcome to the Daybreak Asia podcast. I'm Doug Krisner. We begin with Elon Musk. He's planning to merge SpaceX with his artificial intelligence firm xAI, and we're being told the combined company is expected to have a valuation of $1.25 trillion. Here is Bloomberg's Ryan Gould.
Elon's view is that we're going to have data centers in space, and part of this is about, putting compute and the idea of space exploration and sort of exploration of the universe together. This is clearly part of his vision. There is a very good quote that kind of encapsulates a lot of this, which is what, he wrote, I think, late last year, which is that in some ways his three companies, Tesla, SpaceX, and xAI, are going to come together, they're going to converge. And maybe this is kind of the first leg of the stool that we're now seeing.
That is Bloomberg's Ryan Gould. We're seeing a calmer mood in equity markets across the Asia Pacific after some heavy selling in the Monday session. As one example, South Korean shares jumped by more than 3% at the open. That's after the Kospi tumbled 5.3% in the Monday session. Joining me now is Bloomberg's Paul Dobson. Paul is executive editor for Asia Markets, and he joins from our studios in Singapore. Thanks for being here. So the Monday session, as we both know, was eye-opening, particularly when you look at precious metals. We did have that cratering in both gold and silver prices in New York on Friday, and some analysts were tracing that sell-off to the news on Kevin Warsh being selected as President Trump's nominee to lead the Fed. Do you consider this to be the primary driver of the recent volatility?
I think that markets had just gotten extremely stretched and over-leveraged in the metals space, but not just there, in a lot of the momentum trades as well. And the CTAs were involved, the retail traders were involved. And so it got very, very top-heavy. And so when the correction came with the Warsh announcement, the move was pretty violent and, right before that. So although the correction, the sell-off was really huge, it still didn't even wipe out pretty much the gains for this year, let alone the massive run-up for last year. So you'd only have been underwater if you were very late to the party. So I guess that helped whip it up. Always leverage and people thinking that there's a easy trade and no end.
The other side of that story is the rally that we had in the dollar during New York trading on Friday. It seems like that may have provided the spark.
Yeah, so I think that, dollar negativity, for one thing, had gotten extremely overdone, perhaps, in January. That idea of sell America, that idea of de-dollarization, the quiet quitting, all of those sort of themes had sort of fed into this very negative dollar spiral. And above all else, the idea that the president was trying to influence the Fed and its monetary policy. And I think the appointment of Kevin Warsh really short-circuited a lot of that for a couple of reasons. One, maybe because he's seen as slightly more of a hawk relative to the other candidates, and so all things being equal may not cut interest rates quite as much as others. But actually, when people dug into what he stands for a little bit more, I think there's two other things. One is this idea that he would like a much lower Fed balance sheet, and so that would shrink the amount of liquidity sloshing around in the system, which may firm up the dollar to a certain extent. But even more than that, that he's seen as a credible candidate with a bit of a plan and with a bit of a kind of backbone. And I think the idea that he would actually stand for Fed independence and I guess maybe working in concert a little bit with the finance ministry, with the Treasury Secretary, but at the same time sticking with a kind of Fed and government relationship that stands the test of time was enough to firm people's convictions up a little bit on the dollar. And so it took away some of the motivations and the reasons for the de-dollarization trade, and be that against other currencies or against the precious metals.
So I have to ask you about the U.S. trade deal with India. This is after Prime Minister Modi agreed to stop buying Russian crude oil. What do you think this means, Paul, for the Indian market going forward?
Ostensibly, this is a really big moment of relief for India, which had been underperforming Asia and emerging markets for quite some time. It had its worst January since 2016 in the stock market. The rupee was at a record low. So things were really starting to look rather crestfallen for India because of the weight of the US tariffs. So finding a way out of that at long last is definitely seen first and foremost as a relief. We saw that in the overnight trading of ETFs, which were up around 4%, I think, and the rupee in the NDF market up over 1%. But it's not as simple as that. So some of the agreements, the idea that India can very easily replace Russian oil with Venezuelan oil has problems to do with the quality of the crude and also to do with the price that would need to be paid. So that's not perfect for India. And there are other agreements as well, including how much it has to spend in theory on buying US goods that are also going to be a little bit of a long-term headache. So top line, people are very happy that a deal's done. Underneath that, the details may be a little bit less beautiful for India's market in the long term.
Is there a sense of how Beijing feels about this? Do we know the Chinese side of the story?
It feels like, as far as the US and China relationship is concerned at the moment, there's this idea of just trying to not rock the boat too much. So, it feels like the pressure from the Trump administration on China has somewhat abated. Happy to see the trade just continue to kind of flow through. So I'm not sure that China will react one way or the other to the India trade deal in a great manner. What it might take some exception to is the announcement that we had in the US Day today that President Trump also wants to build this stockpile for rare earth minerals and associated products, which may, weigh on the sector or indeed stoke demand for the sector, particularly outside of China. But I think, again, the idea that the US and other economies that don't have great relationships with China will look to source those materials from elsewhere is nothing particularly new.
We had the official Chinese PMI data over the weekend. Factory activity unexpectedly deteriorated. And then when you look at the non-manufacturing side, that PMI also contracted a bit. I'm wondering about the level of concern here about what's going on with the Chinese economy.
That was a negative surprise, no doubt about it. People don't really know how those numbers looked quite so bad. It's funny, though, because just at the same time as that, I think that there are glimmers of hope for the other side of the Chinese economy, namely the sort of consumer side of things. And what I'm looking at there is sales of liquor actually up in China and recovering, which is usually a sign that people are in a good mood preparing for the Lunar New Year celebrations. We've also seen a pickup in some other areas of consumption. And anecdotally, it sounds like over the Christmas period, things were a little bit busier as well. That said, car sales have down quite a long way. BYD reported that. So it's still a mixed picture on the consumption side. I think for the industrial production side, we'll have to see whether this is part of a longer term trend or just a blip.
So the BYD that you mentioned, sales down in the month of January by 30%. To what extent is that a reflection of just overall demand weakness, or the government, I understand, is kind of scaling back on some of these subsidies that were designed to support the EV industry in China? And as they go away, it's only logical that maybe you see sales struggle a bit.
That's right. So the removal of subsidies is a big deal that the EV makers are going to have to come to terms with. But the size of the drop is large either way. And so the impact on those companies is going to be negative, and on the economy too. China does have these other support measures in place where there's sort of trade-in goods, a little bit like, or trade-in reason, motivation for doing trade-ins, a little bit like the Cash for Clunkers scheme that the US used to have. And it's continuing with that into this year as well. So there are other incentives for various purchases across the consumer complex. But yes, and I think that probably, if those businesses, the electric vehicle makers, are able to stand on their own feet without the subsidies, then that's probably a good, strong sign for the longer term. And I think the other thing is they'll probably continue to emphasize exports, particularly selling into Europe, of course. You
mentioned the Lunar New Year holiday, which is fast approaching. Are analysts reasonably optimistic that Chinese consumers will be spending a fair amount as we look to that long holiday period?
I think relative to what we've seen in the last few years since COVID, there are signs of green shoots and a little bit more optimism with certain caution and caveats. It's certainly not all guns blazing. People are still very worried about the employment situation, but it does seem that there is a little bit more momentum just starting to kindle at the moment. So as we get there, we'll be watching holiday travel, holiday spending, where people are going. Are they going to the movie theaters? What are they spending on restaurants as well? And are they shopping? And if we come through the outside of Lunar New Year with a more complete picture on that, we'll be able to determine a little bit more what that sentiment looks like going into the rest of the year.
Is Beijing still urging Chinese travelers to avoid Japan? I know we had the comments from Japanese Prime Minister Takaichi concerning Taiwan and how leadership in Beijing took offense. That's pretty much why we're in this situation, right?
The dispute with Japan has not gone away as yet, and so Chinese spending in Japanese duty-free stores, for example, is still down considerably year on year. So that's an interesting friction that hasn't gone away yet and seems to be just left to fester at the moment. We haven't heard any more recently from Takaichi in Japan or from the Chinese administration on it. Maybe the plan will be to stop talking about it and hope it goes away over time so that there's a bit of an off-ramp, which I think has been the trend in the past, but it can take quite a long time for those things to blow over and reset.
In the U.S., we had a pretty strong reading on manufacturing for the month of January, the PMI data from the ISM. And I know, Paul, that we've had a lot of PMI figures published for the APAC region recently. Is there a way that you can make some generalizations? Are you seeing slight expansion? Are things in contraction? How would you describe the overall picture?
Coping with the tariff situation and kind of muddling through, a little bit mixed. But the markets seem optimistic about it. In any case, I think if you take away those last few days, so Thursday, Friday, Monday, January was an exceptionally good month for APAC, for emerging markets, in terms of performance. And I think that reflects a certain degree of optimism and the idea that that other regions are going to outperform the US this year. So I do think that it's interesting that actually we're seeing those signs of strength in the US economy, the ISM manufacturing gauge, really strong as well. I would say the other thing that we'll need to focus on, Doug, will be the payrolls report, but I understand that that's not going to come this Friday, so I have to be patient on that one. But one less thing to worry about, I suppose, before the weekend.
Yeah, that partial government shutdown has delayed the release of the employment data, which was set for release on Friday. Paul, we'll leave it there. Thank you so very much. Bloomberg's Paul Dobson. He is executive editor for Asia Markets, joining from our studios in Singapore here on the Daybreak Asia podcast. Welcome back to the Daybreak Asia podcast. I'm Doug Krisner. We mentioned a moment ago the U.S. and India were able to reach a trade deal to reduce tariffs on Indian goods. That was after Prime Minister Narendra Modi agreed to stop buying Russian crude oil. Now, President Trump said he would lower his 25% tariff on Indian goods to 18%. And at the same time, overall levies on many Indian goods will be reduced from 50% down to 18%. And of course, that represents a significant reduction. It'll affect things like textiles, machinery, and other goods. And that's where we begin our conversation with Basant Sangera. He is managing principal at the Asia Group. Basant spoke with Bloomberg TV host Paul Allen and Sherry On.
We don't have a full text of what was agreed to, but can you give us your initial reaction to this news?
Sure. Thank you for having me, Paul. A real milestone moment in nearly 8 decades of U.S.-India diplomatic ties. I think the bulk of what was negotiated in the bilateral trade agreement actually took place last year. There was a moment in July when both sides were very close to announcement. For a number of reasons, geopolitical, India, Pakistan, Russian oil, that agreement wasn't announced then. But both sides have managed to revive a lot of that work. I think in key sectors, industrial goods, spirits, not all agricultural goods, but some items, you'll see wide relief for U.S. exporters. The timelines, I think, still need to be sorted out. The legal text, important to remember that this is a legally binding text. That process to finalize that text is still ongoing. And of course, a huge relief for Indian exporters to the United States after facing that heavy 50% penalty tariff, which will now go down to 18%.
Well, the US would still like India to further lower trade barriers, but how realistic is that? Because agriculture's off limits. New Zealand and the European Union couldn't agree access for dairy products, so why would the US expect any different treatment?
Well, I think it's important to remember that of the deals India has concluded with various partners, including a very monumental EU one, from our understanding is what it's offered to the U.S. has been unprecedented and competitive compared to what is offered other partners. Certain sectors, as you mentioned, particularly dairy, GMOs, those were non-starters, and I don't think those will feature in this agreement. It's also important to remember that this is the phase one portion of this agreement is just going to cover reciprocal tariffs and non-tariff barriers such as quality control orders. There are going to be subsequent chapters, total is 19, dealing with things like digital trade, intellectual property, and most importantly, economic security. As you probably are tracking, the Indian foreign minister is going to be in Washington this week for an important meeting on critical minerals. How both sides can cooperate more on economic security matters, including critical minerals, that's going to be an important part of the follow-on agreement. So again, this is just the first phase, an important one, but the negotiations on those subsequent chapters, they will continue throughout the remainder of the year.
And of course, in order to understand who got a better deal here between the two sides, we still need to see the details, as you're alluding to, but coming into these negotiations, who needed this deal more, President Trump or Prime Minister Modi?
I think India was feeling, confident, particularly given the monumental deal they secured with the European Union last week. I think, as I mentioned, the substance was actually agreed some months ago, but both sides, I think, needed an opportune political moment. And as the previous analyst noted, the Russian oil picture also needed to get into a better place. So the period of political stabilization allowed for both sides to come together and do a leader-level call to make this deal possible.
At a time when trade conversations and geopolitical conversations, when the lines seem to be pretty blurred, you mentioned the critical minerals conversations ongoing right now. How critical will this trade deal be in cementing a stronger relationship between the two sides at a time when we kind of thought perhaps America's Indo-Pacific strategy had wavered?
You're absolutely right. Geopoliticals are at the heart of this, and in some ways, last year, had the India-Pakistan clashes not taken place in April and May, you could have gotten a trade deal last summer, but that was one of the chief obstacles. So it's always important to sort of watch out for those geopolitical black swans that could create frictions down the road. I think critical minerals is very much at the heart of this. The unspoken factor here is China. Both New Delhi and Washington have very real concerns about Chinese dominance in areas like critical minerals and rare earths. And with other like-minded partners, the goal is, now that this first phase is out of the way, how can both sides sort of galvanize cooperation on supply chain resiliency?
That was Basant Sanghera, managing principal at the Asia Group, speaking to Bloomberg TV host Paul Allen and Sherry An, bringing it to you here on the Daybreak Asia podcast. Thanks for listening to today's episode of the Bloomberg Daybreak Asia Edition podcast. Each weekday, we look at the stories shaping markets, finance, and geopolitics in the Asia Pacific. You can find us on Apple, Spotify, the Bloomberg Podcast YouTube channel, or anywhere else you listen. Join us again tomorrow for insight on the market moves from Hong Kong to Singapore and Australia. I'm Doug Krisner, and this is Bloomberg.